It's Atticus Analysis, and today I wanted to talk to you about Nuvation Bio, that's ticker NUVB. So NUVB has two drugs that it's working on. One is ibtrozi, and the other is safucenib. I'm just going to call that Safu. One of them is for lung cancer, the other of which is for a certain type of brain cancer. Both of these are very rare, a small number of patients, but essentially no really good treatment options. So they're kind of going after very niche oncology markets. And they have one of these drugs that is actually, approved, and that's the lung cancer one, and the brain cancer one is in phase 3 trials. Now, the launch has actually gone super well, very, very fast. Everyone was super happy about the launch metrics last year. And as you can see from this chart, the stock was heading up pretty significantly until around November, in which it had a giant spike after it presented data saying that it had a median overall response rate of something like 50 months, which is incredibly strong for niche, hard-to-treat oncology. But as you can see here, while it had this very strong continuation following this, it had a huge drop after the JP Morgan conference, and then it had another drop in March right after it had earnings. So what exactly happened here? Why did the stock essentially lose half of its value in just about 3 months? Well, a few things. First of all, as you can see, the stock used to be super cheap. This used to be a stock that you could buy for less than $2, and it ran all the way up to almost $10. So of course there was going to be some profit taking at some point. But it wasn't just that. There was something that happened, and that is that the company pre-announced revenue numbers at the JP Morgan conference, and there was a concern about talking about how long patients were going to stay on therapy, in which they mentioned that something like 75% of discontinuations were from the phase 3 cohorts. Now, this was misinterpreted by a lot of people, and in fact, a lot of people thought that it meant that 75% of the patients were dropping out but that wasn't what happened at all. What the CEO said, and he clarified this at 2 different subsequent conferences, is of the treatment patients that we've seen discontinuations in, 75% were in the 3rd line or greater setting. And they say later on, if you look at that, that's exactly what you would expect, given that the patients that they get in the 1st line are healthier patients who can get more benefit from the therapy, versus the patients that are in 3rd or 4th line. They've already had several other therapies fail, they're already very sick, and the treatment isn't necessarily going to do that much for them because they're essentially already dying. So what they say here is that if you combine the fact that the patients that are healthier get on the therapy sooner and stay healthier longer, then what that actually looks like is that the overall discontinuation rate would be about 6.5. And this would appear to be higher at the start because there is a lot of patients that are desperate to try this drug. There's essentially no other options for them, and they've been waiting. So you have a higher than normal percent of patients that are in the 3rd line sign up at the start, and some of those patients are going to die very quickly. And you also have kind of this sort of self-fulfilling prophecy, I guess, is that if you start getting 1st line patients and then keeping them on the drug and then keeping them healthier longer, what that's going to do is that's going to extend out the average duration of patient duration for the therapy, just because you're keeping them along longer than they would have, right? So that's a little complicated, but basically what the CEO is saying here is that he says, if you look at what we expected to happen in terms of how long people would be on the therapy, and the overall discontinuation rate being 6.5, that is in fact what we're actually seeing in the field. It's just being distorted by the type of people that signed up initially and the statistical anomalies. If you understand statistics, you would understand that like this is totally to be expected. But a lot of people don't understand statistics, and this is especially true when you have a stock that was so hot. When a stock went from $2 to $10 in the span of less than a year, and then you have some sort of something that could be interpreted as possibly negative news, of course people are going to sell, take their gains, and just move on. So you have the fact that the CEO cleared it up, but people didn't really seem to pay attention. Which is typical. We've seen a lot of that in the past where people take a while to understand what's going on. But you had some good news happen during this time as well. It wasn't just the CEO clearing up the miscommunication there. You have the fact that with the brain cancer therapy, you actually have a very important change in the trial. Originally, it was going to be a phase 2 trial, but they actually amended it to make it a phase 3 trial. Originally, this is going to be something that read out in 2029, but due to an FDA precedent of having a smaller cohort count for a phase 3 trial for a specific unmet need, which is what this counts as because there's only one other treatment available that's not very good. I'll talk about that in a minute. They have gotten approval to make this readout in 2027, and what they have said is that they intend to file for approval immediately in 2027 if they feel like they have the evidence to show that the treatment is 5% better than the existing standard of care or better. And there's every reason to assume that it will be significantly better, and that's because if you look at it, I think the overall response rate is something like 50%, but it's much, much higher. It's something like 88% for their drug. So we have a very, very significant increase in effectiveness for SAFU. Now, this is very important, right? Because as people value this company, they're really valuing the company primarily off of their first drug, right? They're primarily valuing it off of the initial launch that they had, Ibtrozi, but they're not really valuing it off of SAFU at all. And the company has done a lot to try to maximize how much they're going to get from SAFU, right? They've changed the trial design from a phase 2 to phase 3. They changed the way that they're going to do the readout. They've announced that they're going to apply for accelerated approval. And they even bought back the international rights because they were originally going to do a profit sharing thing with the Japanese company. They bought 100% of the rights back from that company to make sure they got all the profit. And there is potentially a lot of profit here, right? So the company that most recently has issued an investor note doing a deep dive into this therapy, right, is most companies have only modeled something like 0.6, 0.7 billion for peak sales for SAFU. But Royal Bank of Canada, their investment bank division, did a deep dive, and they recently increased their price target from $13 to $20. And they said primarily it is because of SAFU, because they say since this ought to be a best-in-class therapy, since they now have exclusive rights that they're not sharing anymore, there is no reason why this can't be a 3.4 billion peak sale here. And this is not potentially that far off from a launch, right? If they're going to get a data readout in mid-2027 and then apply immediately with accelerated review, it's possible they get approval by the end of the year, and we could be looking at a early 2028 launch for a drug that is, best in class with 3.4 billion. Now, it is true that for Ibtrozi, there is potentially some competition coming online, but in my opinion, that competition doesn't matter because the primary way that they're trying to differentiate themselves is fewer side effects. And in my opinion, I don't think that matters for niche, high-risk oncology. We've seen that before with Syndax. Syndax was facing competition from Kura Oncology, primarily with a drug that was going to be approved later, and the primary benefit that they were talking about was less side effects. Didn't matter. And we've seen that with other oncology launches as well, right? I think there tends to be two groups of people who seek care when you have a extremely dangerous disease, right? Group one wants the treatment that the doctor is going to say has the best track record with the best long-term survival rate. And group two says, okay, I don't want to deal with this. The side effects are too bad. I just want palliative care, right? There really isn't a huge market for people that want a slightly less aggressive, slightly less side effecty cancer treatment. I just haven't seen that be a large competitive pressure. So when you have one drug which has proven that it has the 50-month response rate, it's not going to get displaced by some newer upstart company that just says, oh yeah, well, we can also say we have milder side effects. Maybe in 3 or 4 years, when they've proven that their rate is as good, they could slowly start to displace them, but I don't think short term it's an issue. Every analyst across the board basically gives them a buy. They've gotten upgrades. They changed the trial design, which was a huge deal. RBC giving them the 3.4 billion peak sales for the brain cancer thing is huge. That would dwarf the sales of their original launch, which is only going to be like 1 billion. So you have a company that is looking at potentially 4.4 billion peak sales with one drug in the middle of a fairly successful commercial launch with a run rate of something like 200 million right now. You have that, and then you have the fact that the company's overall worth 1.5 billion. You look at something like Bridge Bio, which obviously is in a better position because they've actually had their important phase 3 trials all succeed recently. But Bridge Bio has a peak sales of something like 8 billion to 10 billion, and their market cap is something like 15 billion. So right now their market cap is almost double the peak sales. Versus this company is looking at a market cap which is something like 1/3 of the peak sales. I think that tells you a lot. It tells you that this is a very undervalued company, and it wouldn't take a lot to have a nice return, right? Even if this stock just goes back to where it was, at the start of the year, if the stock goes back to being a $9 stock, from $5 to $9 is still a very, very, very decent return. And that wouldn't necessarily require a huge surge of optimism, right? It wouldn't necessarily require people radically reevaluating the company. It would just require people sort of forgiving it for the couple of missteps that it made and how they communicated the discontinuation rates. Maybe another earnings report where they explain the numbers. Maybe another presentation where they, explain the rise in the overall response rate and people remember that again. And if things just go back to where they were, then, obviously there's a potential for, close to 100% returns just off of that. So yeah, I'm super excited about this. I've put in a lot. I've put in almost a 4% position. But yeah, that's all I have for you today. Let me know what you think, and thanks for listening.